People are always asking me, what's the best instrument to trade? What's the best Forex pair? And in this video, I'm going to break down a setup that I'm looking at on what I think is one of the most powerful currencies. And I'm going to show you why. And I'm also going to show you why there might be more opportunities to trade this particular currency than any other. So get a pen and paper and let's get stuck in. All right, so the pair that I'm looking at is the pound Swiss. That's the British pound against the Swiss franc. And the actual currency that makes this particular setup interesting is the Swiss franc. Why is that? Well, as you can see, when we're trading Forex pairs, we've got the pound Swiss, which means if you're long the pound, then you want this market to go up because it means the pound is strengthening. But you can see that this market is not going up, it's actually going down, which means the Swiss franc is strengthening against the pound. And that's not by coincidence. There's actually a reason that the Swiss franc is so strong. In fact, if we look at the other currency pairs like the dollar Swiss or the euro Swiss or the CAD Swiss or the New Zealand Swiss and all these Swiss pairs, you can see that it's the same pattern. The Swiss franc is just one of the strongest currencies in the world. Now, before I jump into this chart and break it down and show you the technical analysis of where I would look to enter this particular trade and how, let's talk a little bit about the Swiss franc. So the Swiss franc is widely considered one of the strongest and most stable currencies in the whole world. It's appreciated against lots and lots of different currencies over long periods of time, especially the euro and the pound and the dollar. And as I say, it isn't accidental. It's the result of their structural, economic, political and monetary factors that create constant demand for the Swiss franc. And the main reasons are, one, Switzerland is seen as a global safe haven. So when global uncertainty rises, like wars or financial crises or inflation, investors move their money into Swiss assets. Why? Mainly because of political neutrality. Switzerland avoids most geopolitical conflicts. So an extremely stable government with strong legal protections for wealth and very low corruption is very attractive. So during crises like the 2008 financial crisis or the Eurozone debt crisis or COVID, right, where there was geopolitical tensions, global capital flowed into Swiss banks and Swiss assets. And that capital inflow increases demand for the Swiss, pushing the currency even higher. Number two is Switzerland runs persistent trade surpluses. So Switzerland exports more than it imports, which structurally strengthens the currency. They export pharmaceuticals and precision machinery and watches like Rolex and Omega and chemicals and financial services. And what a trade surplus means is foreign buyers have to buy the Swiss franc to purchase the Swiss goods. And that creates a constant structural demand for the currency. Number three is it's got extremely strong fiscal discipline. Switzerland is famous for government financial discipline. They've got very low government debt relative to GDP. They've got balanced budgets. Switzerland even has a constitutional debt break rule. They've got strong sovereign credit rating. And you can compare that to many other countries that just print money to finance deficits. Currencies of countries with large deficits tend to weaken over time. Switzerland avoids that at all costs. Number four is the Swiss National Bank has credibility in itself. The Swiss National Bank, or the SNB, is one of the most credible central banks in the world. And that's because their priorities are low inflation, currency stability and financial stability. Unlike some central banks, they have a reputation for not politicizing monetary policy. Investors trust the SNB and trust strengthens the Swiss franc. Number five is Switzerland is a global wealth storage hub. Switzerland acts like a global vault for capital. Private banking sector, asset management, wealth preservation culture, large pension and institutional investment sector. Large amounts of global wealth are held in Swiss banks or Swiss denominated assets, which naturally boosts the Swiss franc demand. Number six, structural low inflation. So Switzerland historically has had very, very low inflation compared to most countries. Lower inflation just means that the purchasing power of the currency erodes slower, which causes long-term appreciation versus weaker currencies. Number 7's limited money printing compared to other economies. While the S&B does intervene occasionally to weaken the franc because it becomes too strong, Switzerland historically avoids this extreme monetary expansion seen everywhere else in the world. And many other currencies, they weaken due to qualitative easing, deficit monetization, or debt expansion. Switzerland has less structural pressure to debase its currency. Number 8 is Switzerland is a high productivity economy. Despite its small size, Switzerland has one of the highest GDP per capita in the world. Extremely high productivity, highly skilled workforce, advanced manufacturing, and pharma industries. Currencies of productive economies tend to strengthen over time. Number 9, the franc often strengthens because Europe weakens. The Swiss franc is heavily traded against the euro. Europe faced structural issues, slower growth, political fragmentation, high debt levels, banking fragility. When confidence in the euro falls, capital flows into Switzerland, strengthening the Swiss franc. And number 10, psychological status. It's a hard currency. Over decades, the Swiss franc has developed a reputation similar to gold. It's often grouped with the US dollar or the Japanese yen as a safe haven currency. Once a currency earns that reputation, it creates a self-reinforcing cycle of demand. So in simple terms, the Swiss franc strengthens because Switzerland combines political stability, fiscal discipline, trade surpluses, strong institutions, and global wealth inflows. Few countries have all 5 simultaneously. The Swiss franc has actually become so strong that Switzerland often tries to weaken it because a strong currency makes exports expensive. Good problem to have. So that's all good saying that, but what does that mean for us as traders? How can we get involved in this trade? Well, let's look at the chart of the pound Swiss and see if there's a good opportunity right here. Now, I use a process, if you're familiar with my videos, called IPDE, and that stands for Identify, Predict, Decide, Execute. And what we're looking for is we're using a higher time frame to do the identify and the predict, which essentially means we're identifying what the market's doing right now, so the market condition. We're making a prediction, forming a thesis of what's likely to happen next, where price is likely to go next, and how it's likely to get there. Okay, so with IPD in mind, the things we want to pay attention to are the market condition. We want to know the market phase. So right now we know that going from the top left to the bottom right, we are in a bearish market. Okay, there's no doubt about it. 100 traders out of 100 traders would agree this is a bearish trend, right? So if we're bearish and we're in a downward trend, then the chances are we're likely to go down. Now, what phase are we in? The next thing we need to recognize is the phase. Well, if we're putting in lower lows, okay, so we're putting in our runs, okay, and then our pullbacks, and then our runs, and then our pullbacks, we want to be in that pullback phase before we start to look to jump on the trend. So we can tick, we can tick this now and say, great, okay, well, we are in a pullback. Now, what I'm looking at is where we're likely to pull back to. One thing that captures my attention right now is this level right here where we held previously. You can see this, right? This previous level of support. And I like to draw out a zone because none of these levels are, you know, bang on to the pip, but the lowest low to the lowest close looking left will give us this little zone here. Okay, so we're entering that zone right now. We can see that the price is pushing into that zone. If we drop out to the weekly, one of the other things that I love is the significance of this, right? Look at what happened here. So we fell off a cliff back in 22, summer of 22, we fell off a cliff and we pushed all the way down. The bears were really going for it until we saw this rejection. And that rejection tells us a story. It has some significance. And look where the rejection was. Look where the bulls protected that level, that 0612 level or 0600 level right there. Okay, now that has some significance. Look how we fell off a cliff and just stopped. And then the next candle, we try to push all the way down, but we get rejected, bearing in mind that candle is a week of activity. So that's interesting. That gives some more weight to the trade, right? The confluence and some confirmation and some confidence to the setup. Now, what else can we see here? Well, we've got the pullback. we're now back into the zone. What else could we look for? Well, we've got that even handle number. We've got that 1.606 flat level, which is right where we are, 1.06 flat. Okay, so we can have our say even handle number. Now you guys know that when you go to the fuel station and you try and fill up your car and you try and get that bang on the even handle number, right? Psychologically, that happens in the market. So we've got 1.0600, right? Tick. Now the other thing you can look for is indicators. So if we're looking for a retracement and where we're likely to retrace to, some of you are familiar with Fibonacci retracement tool. If we bring on our Fibonacci retracement tool and go from the recent high to the recent low, you can see that we've got that golden ratio, that 618 retracement right there at that level as well, which is interesting, right? I'm not saying that I would trade off of just one of these things, but when you start to combine them, it starts to make for a very attractive entry, right? So now we can say, okay, what about indicators? Well, we've got indicator confluence as well. So we've got fib confluence there as well. And then we can start to look for price action patterns. So maybe we look at deceleration. Let's go down to the 4 hour. You can actually see this is a retest in itself, but let's go down to the lower time frame. Let's go down to the 4 hour time frame, and you can see that as we approach this level, we had this retest. Okay, so we failed to put in a new high at this point, and we're really struggling to push up. We've got this ascending channel here, but look what's happened. We had equal tests of the high, and look at the RSI. We had RSI divergence down here as well. So we had equal highs on price, lower highs on the RSI, which means we can now start to see a clear price action pattern that is confirming that it's struggling. It's running out of steam. Now, if I go back to our little analysis here, we could say we've got a retest. We could say we've got RSI divergence. Okay. And then lastly, you know, what you could also do if you're familiar with trend lines and things like that, you could start to bring on a series of trend lines, and you can go, right, well, from here to here, and then you could go from here to here, right? And you can start to see if there's trend line confluence. Sorry, this one. Here to here, right? And you can start to see trend line confluence where there's 1, 2 tests there, 1, 2 tests there. This is the third test of both of these trend lines. And if you're a trend line trader, that could add some confluence to your entry too. Now, depending on how many points that you fill up here, right? Because you could say trend line times 2. You could be building up a scoring system that says, well, you know, depending on the scoring system, if I get 10 points, I can just enter really aggressively. Like on the market open, I could just enter. I'm going to enter slightly different on this. And the way that I would enter is I look for something called a candlestick pattern. Okay, so candlestick pattern. So after I've got all of this confluence, I then need the candlestick pattern so that I can tick all the boxes. And when all those stars align, I have the most high probability setup. Well, look what we've got here, right? We've got this indecision. All I'm going to do is just remove these so you can see this a bit clearer. So we've got all of this lining up. Just remember that. But what we've got here, right here, is what we call an indecision candle. Okay, this is a doji setup, which means if you think of like a tug of war, during this session, bearing in mind this was a whole day, the bears pushed down, the bulls pushed up, and we just closed, right? But we closed slightly lower than we opened. So it was a bearish day, but it was a indecisive bearish day, all right? The bears only just won, and that's an indecision candle. So the way that I would enter this is I would place my order 3 pips below the low of that candle, and that would be a sell stop, okay? And that's what I would do. That's what I'm going to do tonight on this open. And then my stop loss would go 3 pips above the high of that candle. And that's where my stop loss would go. Okay. And then my target would go down at the lows. And when I say the lows, I'm talking about 3 pips above the lowest low of price action, the previous low. So really, when you draw this out, it looks something like this. which is a great reward to risk profile. Now, if you wanted to split this position, because that's quite an aggressive target, but if you was more conservative and you wanted to split the position and take some money off the table and then let the trade run free, then what you might do is just place your first target at previous structure. So if you look at this inside structure level here, where we had this other rejection, you might not want to fight beyond that, right? So let's just say we can get out, take some money off the table here, and then once that target's hit, we roll the stop to break even, or you even trail the stop loss down to this secondary target, right? So this would be your secondary target. And that way you're locked in. You know, as long as the stop loss is rolled below break where you entered, you're in a risk-free trade at that point. You can't lose money, right? So you've taken some money off the table. Now you're in a risk-free trade. So you take half your position off. So that's what I'm looking at. Now I'm going to show you one more thing, and that is Forecaster. So if you haven't seen Forecaster, this can also give you some confluence or confidence in your trade setup. Now, if you go to type in £Swiss into Forecaster, I'll put the link for Forecaster in the pinned comment and in the description. But you'll see that if we just look at this next couple of weeks, right, you can see that if we're looking at short trades, there is a massive high probability in seasonality. Okay, we've got like a take off the midterm because that's not really needed. But let's just say we go over the last 3 years. Okay, you can see there's 100% strike rate over the last 3 years, 2013 as well. Correlation isn't too high, but it's moving exactly the same way as we did almost in 2013 as well. And when you look at the projection and bring on the single events, you can see it's a lot of bearish movement, right? It gives us some confidence that, I mean, over a 60% chance that we're likely to push down, which is good odds, right? And if you want to find out more about the Swiss franc, like what I went over before, you can go into the Forecaster agent and you can start looking at what's happening. You can look at key events and things like that and learn more about the Swiss franc that way. But the bottom line is, you don't need to be an economist to understand what a good trade is. But when you just paint a picture like what I've just explained, and you understand that this currency pair is strong amongst many others, and the reasons, you know, I've given you 10 reasons why this is strong amongst other currencies. When you start looking at your trades that way, and you're looking for directional trend continuation trades in the direction of that prevailing trend, and you've got that knowledge behind you, it can give you more confidence in your entry. And a lot of traders struggle with, one, pulling the trigger, or two, once they're in the trade, they want to take their profits off early. Well, when you've got this backing you, it gives you a bit more confidence to stick and let your winners run and take more profit off the table. So this is what I'm looking at. I hope this has been valuable to you. If you want to see more like this, where I do more of a breakdown and explain some of the background on the currency and how that fits into the technical analysis, let me know in the comments. Thanks for watching, and if you haven't considered checking out tier1trading.com, I highly recommend you do, or consider taking the 30-day trader challenge, because I know you're going to love it. Till next time, take care, have a great rest of your day, and I'll see you then.